Hello, hello. It is 8:49 p.m. On Thursday, October 27th, for the post-market review. Looking at the economic calendar today, we had, as mentioned in the pre-market analysis, we had a lot of data here, and we were going to wait for 8:30 to have this flurry of data come through the newswire and see if we had any sort of sentiment on the cards here. Now, we had a little bit of mixed data. Well, first of all, let's go with the ECB. They were forecasted to raise interest rates by 75 basis points, and they did just that. So this was heavily priced in. There wasn't too much market impact, but what did have a little bit more impact was ECB's Christine Lagarde with the press conference being relatively hawkish, saying sticking with the same narrative that inflation's too high, we have to be more aggressive, we need to raise rates in the next few meetings, so very hawkish. So this actually had an impact on the overall sentiment for expectations for the Fed coming up in November, early November, actually next week, on the FOMC statement there. So a little bit of foreshadowing, and investors now expecting a little bit. It's helping the sentiment of expectations of more hawkish tone coming from the Fed themselves as well. So that was helping the US dollar bulls. Now, at 8:30 we had the data come out. Core durable goods came out pretty bad, actually. Actually the month over month shrank, so it was a lot less than forecast and a lot less than previous. But just the regular durable goods also was less than forecast, but higher than previous. So this was a little bit disappointing. But what held the most weight, in my opinion, was the GDP quarter over quarter Q3 coming out 2.6%. So higher than forecast and much higher than previous. Previously we had a shrink, and now we had a 2.6, which is a huge increase comparatively speaking. So as mentioned in the pre-market analysis, if we are going to have a high GDP for the quarter reading, this is actually bearish for the stock market. This is actually bullish for the US dollar, and this goes hand in hand with the narrative of this Fed aggressive rate hike cycle, because a rise in GDP signals that the economy is really strong, and the mission of the Federal Reserve is to bring down inflation. And right now the economy is much too strong, that inflation, so far the rate hikes that they've done has had zero impact on inflation or the economy. GDP is still strong, employment data is still strong, inflation is still extremely high. So this is bearish on the stock market, because this just means the Fed has to continue being aggressive with their rate hikes, right? So this, in my opinion, had the most weight here. The GDP, the higher than expected GDP here. Jobless claims also was a little bit better than the forecast, but less impactful than the GDP, in my opinion. So let's look at the markets today, and starting with the currency market. So as expected, we were in this range here, and with the catalyst of the high GDP, we saw bears come back to the table and print new lower lows, breaking below this consolidation zone and breaking below this key level 3,800, which was the previous bullish structure level. So this sentiment from the high GDP caused this sell-off here, as investors are starting to price in that, well, you know what, maybe the Fed is not going to slow down, right? So this Fed slowdown hopes is what fueled this pullback structure here. And now as we retest conveniently on the dot, my daily breakout structure 38.82 on the dot, rejection, and then all of a sudden we get data, strong data for the US, and then breaking to the downside here, starting to see a shift in behavior here and seeing some exhaustion of buyers and sellers start to step in the markets here. So ahead of the FOMC, if this sentiment continues, we may end up getting some continuations of the sells on the way down here, as any Fed slowdown prayers just get wiped out by Jerome Powell raising interest rates 75 basis points, continuing to say that inflation is way too high, continuing to say the U.S. economy is still very strong, there's still work to do. We're going to bring the rates up to to a certain level, 4.5%, and keep them there for 12 to 18 months or 18 to 24 months or whatever they say. They're going to keep them there for a long time, and I don't think the market really understands what this implies, what the Fed is actually trying to do. Or they do understand, and this is just a price grab so that sellers could get in at prime prices prior to the inevitable drop of the stock market to retest the lows and potentially create even new lower lows here. And on the US dollar, we see the correlation here as we retest key supply levels on the higher time frame. Right, zooming out, this was the key price levels that led to these new highs. As we retest on the way down, this aggressive pullback comes to retest this level on the dot, 109.5, and we start getting some bullish price action from this level. So again, this is still just technically a small pullback in relation to this downside, but you can't forget that fundamentally the dollar is extremely bullish, and we're still respecting higher time frame bullish price and market structure. So there's nothing bearish about the US dollar if you zoom out, right? It's extremely bullish. So this is still just a small correction of this pullback structure here, but I do see a shift in the sentiment. I do see the shift in the sentiment because we are breaking back above these previous highs here and actually staying above for the time being. And even if we come back, now that we created this new higher high, we see that the sellers are exhausting. We see that the buyers are starting to step in at prime price levels after this pullback. We could even come back to retest these key levels around 110, 109, even double bottom at 109.5, and start our way back up to the upside here, right? So as long as we are holding this level, and Jerome Powell next week comes in with the heat, saying that all the things that we were talking about, that rates are coming up, inflation is too high, we're going to have US dollar bulls come back to the table, and we're going to go retest these highs here. Right. So overall today there was no active trades, as I was looking to play the sentiment of US dollar bulls, but US dollar bears and the optimistic sentiment to potentially retest better sell areas. But as we can see, we had some indecision within this range, and we didn't get any of my trade ideas play out. I'm actually going to delete these trade ideas because I'm no longer going to be looking to trade that based on the US dollar strength here. I'm going to be potentially adapting my trade ideas. But again, GU is a little bit more bullish because of the pound individual strength. But at this point, we're looking like the buyers are exhausting, as this bullish structure was consecutively creating these higher highs and higher lows, and then recently we had this higher high lose momentum. We saw an accumulation of sell orders, an attempt to double bottom to create some buy side liquidity and demand here, but failing to break, actually creating a wick rejection. And now during the Asian session, we're retesting these lows again, looking like sellers may start coming into the scene and printing these new lower lows here. But can't forget that this is a significant level here, but I'm not going to be expecting a continuation to the upside. We may get a bounce from here, even coming back up to retest these highs after, but I do see some sells coming back as the fundamental bias of US dollar domination will cancel out any of those optimistic UK headlines, as the US has been dominating during this rate hike cycle, and the pound is just another one of those currencies that is going to catch the bullet and feel the pain. So just to recap today's session, we did have a nice little bounce from here, but rejecting the high side of the range, so just stuck within this range here. There was an opportunity to buy it here, but again, I was waiting for better confirmations, and I had mixed sentiment, and gold is even messier. Basically, just a tough day where I didn't take any trades today because the sentiment was mixed. There was low volume and volatility. Market structure was conflicting. Price action was choppy and messy. There's just no great trade opportunities for my trading style, where I'm looking for bigger ranges to catch, and I'm looking for a clear sentiment in the market in order to place any trades, and there just wasn't anything to play on today. And during the New York session on gold, especially ugly here. We're up, down, up, down, up, down, with every single candle closing within this box here. So extremely ugly day in terms of price action. But again, I think we're setting ourselves up for some clean return of the bears. So for gold, we could even come back up to retest these key levels here. Previous rejections, as you can see, sellers stepped in here, sellers stepped in here, sellers stepped in here and here. If we come back up to retest the zone again, sellers will come back and potentially start this return of the bears, as I mentioned. And this key level here, 1655, would be my area where I'm looking for safer scale-in sells, breaks, and retests below for the continuation of the sells here. If by chance we do break above this level, I'll be looking for nice prime higher time frame liquidity zones rejections around 1680. This is a weekly breaker structure. This is a major liquidity zone, so looking for reactions at 1680, 1681 for those sells here, and be starting to be cautious here, playing the pullback, as we're nearing tomorrow's the end of the week, and then next week we have the FOMC. So we might see some choppy price action leading up to it, unless the sentiment starts coming in a little bit earlier. But I'm predicting that investors are going to be waiting on the sidelines until Jerome Powell comes in and says what he needs to say. So that's it for my market recap for today. I'll be back tomorrow for my pre-market analysis video.